Hello and welcome to this carrier update. I'm here with the one and only Zach Strickland. Zach, you presented some really cool stuff, so I'm excited for this next segment.
Yeah, let's go ahead and zip through this. For those of you that have been here, you're gonna know what this is. This is our outbound tender volume index, easing signal right now. Something to watch moving forward, especially as we enter into December, January. This kind of trend line persists. It's kind of an indication that shippers are taking a break. And maybe they're expecting something, maybe they're seeing something that we don't necessarily. Very interesting signal here in the OTVI. Definitely one to watch, especially since the timing of it is very unexpected right before Thanksgiving. Could be supply chain issues, could be some of that consumer confidence that they see occurring there, kind of easing a little bit. Could be inventory management situations. It's hard to tell right now, but it will be impacting the freight market. And whether or not that's a long run or a short-term blip, we'll have to wait and see what happens in December and January for that. Let's go ahead and get into the next chart. Tender rejection rates, the OTRI, bouncing higher. If that demand had stayed higher, I think this would be going a lot higher, a lot faster. But it's kind of easing off a little bit. But we're back up over 20% for the first time in a couple of weeks here, since about November 1st-ish. So we expect these to continue to grow. We're looking at these signs around Thanksgiving, Christmas, increasing tender rejection rates and inevitability at this point because of drivers coming off the road. Let's look at the weighted rejection index map next. See some of these. We're seeing a lot more blue on this map than we have been. And this is what's driving that rejection rate higher. Nashville, Kansas City, Ontario, all showing dark blue. Jacksonville, Indianapolis, Detroit, all showing in the reds and oranges. That's an easing signal. So rejection rates are falling there significantly. Dallas and Charlotte also areas to watch here over the next bit because they're increasing in tender rejection rate and they do have the volume to back it up. You see Charlotte has a lot of outbound, but what you can't see here, Charlotte also has a ton of inbound. Very backhaul centric area of the country, but nevertheless, rejection rates are increasing. Let's look at Ontario and Kansas City and the tender rejection index map or chart here. Kansas City, really volatile market early on in the year. And it's kind of been settling down a little bit until the last bit here. We've got a huge increase, 31.2% tender rejection rates. That means a lot more spot market activity possible here because they're bouncing down the route guides, not getting the compliance in the contracted space that they were just a week ago, but a big jump here, especially when you see these big sharp signals, Anthony. That's really a sign that, hey, you have some immediate need or necessity in that area. Ontario, California, kind of the benchmark market over the last year or so of activity in the freight market because all the carriers trying to get back to Ontario to take advantage of some of these elevated rates. So I want to show you next what this kind of translates into. Let's look at the next chart here, which I believe is our Ontario tender rejection lane map or lane tree map. I want you to kind of look at the difference here between these two areas. So we've got Ontario to Atlanta over there, leading the way. Big jump too in the tender rejection rate going Ontario to Atlanta. Now pick out something over here like Ontario to San Antonio, 17.9%. It's underneath Atlanta. Now why would that be? Let's look at our next, let's look at some market dashboard track rates here. We've got our lane to Ontario to Atlanta, $3.58 a mile on average right now, and it is getting higher. You can see we've taken a big jump over the last week or so from Ontario to Atlanta. Long haul lane, that's a ton of money. You've got your mileage up there. What is it, Anthony? Is it 2,100? Yeah, 2,100. 56 miles, $3.58 a mile. That is an expensive lane. We've got a pretty tight boundary around that rate too. Confidence score of 5, that's how I know that. That means that we've got a lot of data points or rates sitting right around that mean, that average number there. That high is $3.71, $3.43. Tertiles, not gonna teach statistics today, but that's a pretty tight little range for such a lane that is in such high demand and rates getting higher right now because Ontario, of course, one of the tightest markets in the country. It's very difficult to reposition yourself into that area.
Yeah, that was an impressive tree map, seeing that Ontario in just nothing but green, not a sign of red in there. So really showing what's going on within that market. And Zach, real quick, can you tell us what that confidence score means of 5?
Yeah, that 5 basically means that we have a lot of volume and data that's tightly packed around that mean. Current data at that. And you can obviously, the track users can hit that little arrow there and see all the metadata behind it that explains what data is giving this result here. I want to show real quick the next chart, which is Ontario to San Antonio. Remember, $3.53, Ontario to Atlanta, $4 a mile to San Antonio. Now, it's not a contract rate, but that's why those rates get accepted more frequently, because they cost a lot more. San Antonio is a very backhaul-centric market, but the contract rates have increased significantly in that area.
Zach, I'm loving how all of this ties together, from those initial charts to the tree map to the track spot. It's amazing stuff. Thank you so much for joining us for this carrier update.